These series of videos will go from the very basics of options trading all the way to the advanced level, even if you've never heard of stocks or options in your life. Before we dive in, quick disclaimer, I'm going to put it on the screen for a few seconds, pause the video and read through it before moving on. I'm going to pretend that I'm teaching myself as if I knew nothing about stocks or options. I'll be taking both the role of sensei as well as student. Hey kid, we're gonna go on an amazing journey. Once you get to the end, your life will change forever. I'm going to start off slow. You may know a lot of this information already, but I'm going to level set from the very beginning. If there's anything you don't understand, then just go back and rewind the video. You can also reach out to me if you have any questions in Discord. It's really important to understand the basic vocabulary of what we're going to be talking about here. You will have to know everything like the back of your hand. Before we talk about options, I'm going to tell you a little bit about stocks. When you buy a stock, you're buying a small piece of a company. A stock is something you can buy and sell, and its price goes up and down. That's it. Hypothetically, let's say you buy one share of Google stock at $100 a share. Now let's say the price goes up to $150. If you sell it at $150, you just made $50 profit. This is what people mean when they say buy low, sell high. You buy at a lower price, you sell at a higher price, and you keep the difference. But it can also go the other way. If you buy at $100 and it drops to $50, now you're down $50. So it's not guaranteed. You can win or lose. Now that you understand that, options are another way to make money based on these price moves without buying the stock the same way, and that's what we're getting into next. An option is exactly what it sounds like. It gives you the option, but not the obligation, to buy or sell a stock at a specific price. What that means is you're not actually buying the stock right away. Instead, you're buying a contract that gives you the choice to buy it later or sell it later if you want to, and you can either use that option or do nothing at all. That's the key difference. With stocks, when you buy it, you own it. With options, you don't own the stock. You're holding a contract based on what you think might happen next. And yes, you can make money if you're right, but options aren't as simple as stocks because you can be right on direction and still lose money since time is always working against you. The person selling the option doesn't have a choice. They take on an obligation, but are paid a premium for taking on the risk. Now let's talk about two things that make options different from stocks: the expiration date and the strike price. Every options contract comes with an expiration date. This is simply the date when the contract expires. After that date, the option is no longer valid. So unlike stocks, where you can hold them forever, options have a time limit. If the move you're expecting doesn't happen before that date, the contract can lose value or even become worthless. That's why timing matters a lot more with options. The second piece is the strike price. The strike price is a price that the option is based on. It's the price where you have the right to buy or sell the stock if you choose to use the option as an option buyer. For example, if a stock is trading at $100 and you have an option with a strike price of $110, that means your contract is based on the idea of the stock moving up to or past $110. The strike price is basically the target price that your option is centered around. Now, one more important detail. Each options contract typically represents 100 shares. So when you buy one contract, you're not just controlling one share, you're controlling 100 shares. For example, if an option is priced at $2, that doesn't mean it costs $2 total. You multiply that by 100, so it actually costs $200 for one contract. Let's dissect an options contract. For May 26, 100 SPY, 733 call +1. For May 26 refers to the expiration date, meaning this option expires on May 4th, 2026. 100 refers to the contract size, meaning each contract controls 100 shares of SPDR S&P 500 ETF Trust. SPY is the underlying asset, meaning this option is based on the SPY ETF. 733 call refers to the type of option and the strike price, meaning it is a call option that gives you the right to buy SPY at $733. And +1 means you are long one contract, meaning you bought one call option. So altogether, this means you bought one SPY call option that expires May 4th, 2026, and it gives you the right to buy 100 shares of SPY at $733 before that date. This is going to sound like a lot of information from the get-go. Watch this a few times until you understand it. Before long, it will all be second nature to you. Let's do one more example. For May 26, 100 SPY 733 call -1. For May 26 refers to the expiration date, meaning this option expires on May 4th, 2026. 100 refers to the contract size, meaning each contract controls 100 shares of SPDR S&P 500 ETF Trust. SPY is the underlying asset, meaning this option is based on the SPY ETF. 733 call refers to the type of option and the strike price, meaning it is a call option that obligates you to sell SPY at $733. And -1 means you are short one contract, meaning you sold one call option. So altogether, this means you sold one SPY call option that expires May 4th, 2026, and it obligates you to potentially sell 100 shares of SPY at $733 if the buyer chooses to exercise before expiration. Let's break it down for our 4 single leg scenarios. Buying a call option means you have the right but not the obligation to buy 100 shares of the underlying stock or ETF at the strike price before expiration. So if you buy a call and the stock goes up above the strike price, you can exercise it or sell the contract for a profit based on that increase in value. Selling a call option means you collect premium upfront, but you take on the obligation to sell 100 shares of the underlying stock or ETF at the strike price if the buyer chooses to exercise, which means you can be forced to sell at that price even if the market price is higher. Buying a put option means you have the right but not the obligation to sell 100 shares of the underlying stock or ETF at the strike price before expiration. So if the stock goes down below the strike price, the value of the put increases because you can sell at a higher fixed price than the market. Selling a put option means you collect premium upfront, but you take on the obligation to buy 100 shares of the underlying stock or ETF at the strike price if the buyer exercises, which means you are forced to buy at that price even if the market price is lower.